Welcome to the Killik & Co weekly podcast for the 29th of September. Obviously, during the course of this week, we creep into October, and the first week of each month normally heralds a raft of new data points, non-farm payrolls, for example, in the US, and it's often the time central banks come along and talk about interest rate decisions. Unusually, the Bank of England will delay their decision until next week, although there are some data points out this week, particularly on construction and manufacturing, which will become relevant to the conversation in the UK, but we will hear from the ECB. Now, the ECB is not expected to make any rash moves this week, no further interest rate cuts following on from last month, but it may give an opportunity, particularly in the press conference afterwards, to discuss areas such as this continued worry over the low levels of inflation and what actions are going to be taken to try and defend Europe from that situation. Let's turn to the corporate calendar for the week ahead. Just a couple of names that are highlighted in blue, in the darker colours for us. On Tuesday, we will hear from Wolseley in the plumbing centre business, which has significant operations in the US and Europe. And on Thursday, we'll also hear from Breedon Aggregates, a recent buy recommendation, which does have some interest in Scotland, so will have been sort of relieved by the recent referendum decision around Scottish budgets. Breedon is involved in supplying the aggregates that go into the construction industry. So a bit of a construction theme coming on. Really, again, the focus, as I mentioned, is going to be on the economic data points, and it's the ECB's Draghi will speaking on Thursday, and then, of course, the non-farm payrolls number on Friday of this week. There will be a heads up on employment in the US with the ADP on Wednesday. That's obviously an often watched key indicator ahead of that number for later in the week. Current forecast for the payroll will be around about 200 to 210,000. If we do hit that number, it will be returning to normal trends given the slightly disappointing data we saw last month. Let's turn to a few charts. FTSE 100, highlighting here that we have seen quite a sharp sell-off in the FTSE 100 over the course of the last few sessions, shying away from that 6,900 level, which we commented upon just 2 weeks ago, that the failure to break through there was disappointing. But we've rattled back, getting quite close to year-to-date lows, 66.21. No real reason for the underperformance. It feels like a combination of things coming together. But London certainly has suffered more than most markets around the world. And we'll talk a little bit about profit warnings later because we have had a fair few of them recently from businesses. Slightly in contrast to the more positive tones that we're hearing about the economy, the sustainability and durability of the recovery we're seeing in the UK economy at the moment, but we're seeing 1 or 2 profit warnings. So FTSE is underperforming at the moment and getting quite close to year-to-date lows. It's down still sub 2% year-to-date, and that's with dividends stripped out. The S&P 500 really just give a sort of compare and contrast that yes, it's off its highs, having broken through the sort of 2000 very temporarily back to about 1982, but certainly proving to be a more resilient market as we speak. And Japan, well, that's really the breakaway success at the moment. Economic policies around inflation, the devaluation of the currency, really what impact that is having for companies that own significant businesses overseas. The translation effect of those profits back into a cheaper currency has meant that we're continuing to see growth in the Nikkei 225. We have been commenting upon this as a place for making sure that you are appropriately weighted to Japan recently, and it is showing a clean pair of heels to the rest of the market in the current trends. US dollar, I'm going to bring this chart up one more time. We reported it last week showing that the dollar is strengthening around the world. That has continued during the course of last week. And so dollar strength, it is negative commodities. It's also slightly negative to the emerging markets. So there is some underperformance coming through in some of those industries. And if we look at oil, that's really my chart to summarise what the dollar strength is doing to oil. It's a factor in some of those harder and soft commodities. In the recent weakness, we can see there that that decline from 115 down to 96, quite a significant decline, but helpful towards lowering the operating costs for business and consumer spending. So that continues to remain a chart of interest for us. Just want to sort of highlight the impact of a few profit warnings last week. You can argue very much that these are company-specific items, but just feels, as observers such as myself, that we're seeing two more warnings coming through. But moreover, the impact on the share price is quite significant. Sometimes warnings can be absorbed within company share prices as there's a level of expectation that the companies may well warn on profits. But just giving you an idea of the magnitude of the fall, Tate Lyle was looking a very nice chart up until that warning. It was recovering from those sort of end of July lows of just under 650 and rallying towards 750. So there was certainly some good buying taking place during the course of the last month. So that warning very much a surprise and taken the company down to very much year-to-date lows and putting this company back. And so specific warning there for Tate Lyle, but it's not alone. De La Rue, again, another company which warned very, very significantly on profits, material shortfall in profitability at De La Rue. And again, a complete surprise to the market, and that has been shown in the price this morning. This is one for today, Balfour Beatty. Less of a surprise here because the company has had one or two attempts this year to disappoint the market. This first happened back in May, where they uncovered some profits shortfall within their business. Construction is a notoriously low margin business, and cost overruns in a business that is inefficiently managed can come to the fore at times of stress. And of course, we've had that first warning. There were some discussions here with Carillion about a potential merger, which didn't come to anything at the end of the day. But having obviously got into the business, they're looking for a new CEO. There has been found another 75 million profit shortfall. So that really two hits to Balfour Beatty over the course of this year. So really just sort of overall message here is that whilst macro conditions are continuing to improve, just be careful of the specific profit warnings. They seem to be coming through a little bit sort of faster to us at the moment, and this sort of share price reaction indicates the market is ill prepared for these at the moment. So one to be watched very carefully.